Hello, in this video we'll continue with our gross income set of problems. This is problem 3. Lemon and Lime, they organized a corporation and they each contributed $50,000 of cash. In exchange, they got 500 shares of common stock having a par value of $100 per share. And now at the end of the first year, the corporation had accumulated net earnings of $100,000. So we have a similar fact pattern to what we saw in problem number 2. So please look at that if you haven't yet, and you get a general idea of some of the issues. Now, specifically, there's going to be two events that take place with respect to this transaction. We need to go look at the gross income consequences. So the corporation declared a $100,000 dividend, which each shareholder gets $50,000. We're looking at gross income. So if you remember, Internal Revenue Code Section 61 defines gross income as income from whatever source derived, so it's very broad. So we have to go to our Glenshaw Glass definition of gross income, which is a Supreme Court case. And in that case, the court said that gross income is when a taxpayer has a undeniable accession to wealth, which has been viewed as when net worth increases, which again we can quantify through an accounting definition. Net worth is assets minus liabilities, and there must be it must be clearly realized. So there must be realization where there is a severance, a legally severable event, and I'll explain more about that in a moment. And finally, there must be dominion and control, which I usually abbreviate D and C. Dominion and control deals with are there strings attached in terms of the use of the actual inflow coming in. So another thing is that we're looking at what amount of income, who, and when. We have to focus on those 3 questions in terms of our 5 questions that we always address in all tax consequences. We're not looking at the other issues about character and outflows because that's not really relevant when it comes to gross income, which is what we're worrying about here. So this corporation declares a $100,000 dividend. This is after that first year. So the corporation, after the first year, had accumulated net earnings of $100,000. The corporation is going to declare that $100,000 as a dividend, and then each shareholder that year gets the $50,000 of cash. So $50,000 to Lemon, $50,000 to Lime. So we're looking at that $50,000 of cash. Is that going to be gross income to Lemon and Lime? So we go through our definition of is it gross income. So with respect to net worth, have assets gone up? Well, before, Lemon and Lime, they each own stock. They each contribute $50,000 of money for $50,000 of stock. And then after, they have the $50,000 of stock, plus they have $50,000 of cash. So both Lemon and Lime, that's who our who is here. We're looking at both taxpayers individually. Yes, assets have gone up by $50,000 each for each for each taxpayer. So yes, we do have net worth. So number 1 is satisfied. Net worth has gone up. The when question, we're specifically focusing on just when the shareholder gets the $50,000 of cash end of the year. What about realization? So we saw in previous problem how if the value of the stock just goes, if the corporation has accumulated net earnings, well, both Lemon and Lime, they own the shares, the 500 shares of common stock, but they don't have any, and yeah, the value of the stock goes up because now the corporation has this money, but they still own 500 shares and there's no legally separate, you can't separate out that amount, that 100,000 or 50,000 each from the 50,000 they originally contributed. They just have the shares. You can't separate it out because it hasn't been severed. Those things, it's still part of the same property, that stock. But here, there's $50,000 of cash. So when you're looking at number 2, realization, the way I look at it is for each shareholder, you can separate out the 500 shares of stock, which they had before, which after they have the 500 shares, plus they have $50,000 of cash. So when you separate out, this is now severable because it's been severed. There's been this severance, this line. This is severable. It's separate from the 500 shares which were initially in the business. So this is met as well, realization. And finally, number 3, dominion and control. The issue becomes Are there any strings attached with respect to, are they allowed to do whatever they see fit with that money? There's nothing here that indicates they're limited in terms of restrictions with that money. So yes, that's met. So yes, the $50,000 that each shareholder gets is gross income. So that means that Lemon was going to have to record $50,000 of gross income with respect to that dividend that Lemon gets, and Lime is going to have to record $50,000 of gross income on their tax returns, on their separate tax returns. Now let's change up the facts. What if the corporation declared a 1-for-1 stock dividend, which each shareholder gets 500 shares? So they're saying the shareholders have the same shares. They have the same shares. All right? They have those same shares. We have the same analysis. We got to go through our net worth, our realization, and our dominion and control. And again, our what, who, and when. So in terms of who, it's Lemon and Lime as well, right? We have Lemon and Lime. We're looking at each of them for their individual tax returns, but they both get 500 shares. We look at when, we're looking specifically at when they get the 500 shares. So what we're saying here is before they had just 500 shares. After they have the same 500 shares, but they also have a new set of 500 shares as well. A new 500 shares. So this time I want to go the opposite order. Dominion and control. Do Lemon and Lime have dominion and control? And the answer is yes. There's no restrictions on those shares. We're not told, oh, they're not allowed to use them within a certain period of time, or they have to hold on to them for a certain period of time, and then they can exercise or sell them or whatever. Dominion and control, number 3, is met. They can do whatever they see fit. There's nothing in the facts that indicate they can't. What about number 2? Do we have a severable event, a legally severable event? So what we're looking at here is before and after. Before there's 500 shares, after there's 500 shares. Yes, because having this new 500 shares means it's severable. It's separate. You can actually count out the original 500 shares, and then you can count out the old 500 shares. So that is a realization event. That means there's been a severable event in terms of the initial, what was there. Finally, the last thing, net worth. This is probably the most tricky item here. And the reason for this is because with a 1-for-1 stock dividend, all that takes place in the stock dividend is owner's equity or stockholders' equity for a corporation simply gets moved from one side of stockholders' equity, which is the retained earnings side, to the other side of stockholders' equity, which is the paid-in capital side. So from a net worth standpoint, actually, the assets stay the same. The assets stay the same. There's no change. They're equal. There's no effect to liabilities and owner's equity. So there's actually no change to assets with respect to a stock dividend where everybody gets the same number of shares. And the reason for that is because when you look at before the stock dividend, the value of the corporation was the corporation plus the $100,000, was the value of the stock at the time of the accumulated net earnings. And afterwards, it's also the same thing. So what we're saying is, what if, think of it like this. This is easier to consider. Because if some of you are out there and you're still confused, then just think of it like this. So in terms of, think about it from the initial date. So on the initial date, the par value of the share is $100 per share, which is the 500 shares times the $100 per share is $50,000, but it's also the fair market value because they each contribute $50,000. They each have equal share in the stock, and guess what? They each have $100 par, but they also have $100 value. So before the potential stock split I'm going to mention, the fair market value is $100. After, so let's say the same day, this is unrealistic, but this could happen. The corporation decides to do a stock dividend or a stock split, either one. Let's just do a stock dividend. of a 1-for-1 stock dividend of 500 of a 1-for-1 stock of 500 shares. So the question becomes, that day where there's been no value creation, what is the fair market value of the shares? Well, the fair market value is going to go down because there's more shares. Now each shareholder has 1,000 shares, but the company is still worth $100,000 total. So there's 2,000 shares total. So after, the fair market value goes to $50. So economically, their assets haven't gone up because they still, yes, they own more shares. They own twice as many shares, but they still own the same value. And that's what we're saying here. We're comparing when the corporation, before and after in terms of the accumulated net earnings, what the value is before in terms of what it is after. If you look at the value of the 500 shares before the actual stock dividend, taking into account the $100,000 of net earnings, it will equal the same total after as well with the stock dividend. And that's the reason why assets are equal, and that's the reason why with a stock dividend that is equal across the board for all shareholders, there is no gross income that's recorded by either shareholder. No gross income to either lemon or lime. And again, the key is that if you look at the before and after, the before is $100 fair market value for each share, after is $50, but now it's doubled. So you're talking about 100 times 500 shares, and then 50 times 1,000 shares, and in both cases, it's going to equal $50,000. And guess what? Equal is equal, so assets haven't gone up. So therefore, again, net worth is not met. Number one is not met with respect to the 1-for-1 stock dividend. So I hope this helps you understand the idea of how net worth sometimes cannot be adjusted, especially when it comes to like stock dividends.